Did anyone notice that the 10-year, 2-year uninverted forestalling recession fears? Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today we're going to be talking about 10-year, 2-year spreads again, potential recessions, and what it means for 2020 as President Trump looks to get reelected. Don't look now, but if you were planning on a recession, to oust President Trump by causing a spike in unemployment because you were seeing these bond market signals, you may have to keep on waiting. The 10-year, 2-year Treasury has uninverted since September 4th. It only went below zero. That's the 10-year rate becoming lower than the 2-year rate for about 6 trading days, and then it's uninverted. Now it could invert again today or tomorrow, next week, next month. But the fact is that usually over the longer period, the 10-year, 2-year will tend to invert for weeks or months prior to a recession. Usually happening about 16 months after the inversion, but usually it's a steep inversion and it will stay down for weeks and months. Here you had a very shallow inversion and it only stayed there for 6 trading days. So could this be a repeat of history? We've seen this before. In 1998, there was a brief inversion of the 10-year, 2-year. The Fed acted quickly to cut interest rates. The inversion was cured, and it turned out that you were not going to get a recession until 2001. So that was actually a false signal sent by the bond markets. And that could be what's happening again here. So sorry, Democrats who are hoping for a recession, but we might not be there yet. You might have to keep on waiting. And it might not help oust President Trump in 2020. Sorry to say. But is it a false signal? The answer is we don't know yet. Again, it could invert today or tomorrow. We're not that far from to going negative. We're clearly towards the end of the business cycle, but sometimes those cycles can be extended. The Federal Reserve has already cut interest rates at its July meeting. It's meeting again on September 17th and 18th, where I think markets are predicting more interest rate cuts, and that could help cure any other inversions, for example, between the 10-year federal funds rate or the 10-year 3-month. Those inversions could be cured, but markets are betting almost certainly that the Fed is going to cut rates. I wouldn't be surprised. I certainly agree with that consensus. And now President Trump has been saying that interest rates are too high since last October and has been complaining about the dollar being too strong and flattening U.S. exports. I think President Trump has a point there. The dollar is very strong. On a trade-weighted basis, the dollar's never been stronger in 2019. So I don't know how much stronger it could possibly get. So usually the Fed will ease rates into the end of the cycle. Even if we're a couple years away from that, it could start easing right now. Again, like 1998, and that could you could get another bull run on markets. And I wouldn't be surprised if that's actually what happens here. It could invert again. You could go into a full inversion like it happened in 2000, and then you might see a recession 16 months later or something like that. But right now it's a very shallow inversion, and so therefore no need to panic if you're worried about a recession. President Trump certainly wants to see the Fed cut interest rates. On September 11th, he said, quote, "The Federal Reserve should get our interest rates down to 0 or less, and we should start to refinance our debt. Interest could be brought way down, while at the same time substantially lengthening the term. We have the great currency, power, and balance sheet. The USA should always be paying in the lowest rate, no inflation. It is only the naivete of Jay Powell and the Federal Reserve that doesn't allow us to do what other countries are already doing. A once-in-a-lifetime opportunity that we are missing because of boneheads." Here, President Trump is referring to Germany has been going negative on its interest rates, as has Japan. And this is leading to more demand for U.S. treasuries. That strengthens the dollar. And I think is what has President Trump concerned about, frankly, the interest rates and markets and potential bond market signals and potential recessions. President Trump doesn't want to see a recession, certainly not before 2020. So he hopes that the Fed keeps on easing. We'll see what the Fed does. I think they're likely to cut rates. And we'll see what happens. Trump's referring to the negative rates, but negative rates could foreshadow weaker economic growth over the longer term, and also signal deflationary conditions, just as Germany and Japan, how well they're growing right now. I don't think they're growing that much at all. Europe is in kind of a stagnation. Japan hasn't grown its economy nominally, or it's grown a tiny bit in the past 20 years. And that's with near zero interest rates or negative interest rates. I don't know if it actually helps to strengthen growth, but I suppose is one way that the dollar could be weakened. There are alternatives. For example, we've talked about warehousing, where the Federal Reserve and the Treasury can take actions to sop up foreign currencies. And this could have an impact of weakening the dollar, and could help forestall these bond market signals and maybe kick out a recession to later. It's always a question of what's going to cause the next recession. I say a very likely candidate would be the strong dollar. It's way too strong. President Trump's not wrong about that. And we've seen where it's actually hurting U.S. exports. A definite relationship between the strength of the dollar and exports rising and falling. If the dollar gets too strong, exports collapse. If the dollar weakens, then exports can strengthen. So you could get a little boost of GDP right now, I think, with a little bit of a weaker dollar. Fed wouldn't have to move too much. So we'll see what happens there. They're meeting on September 17th and 18th. They may cut rates. And we'll see what happens there. Now, we've spoken out against negative interest rates, but markets might not leave the Federal Reserve with much of a choice. If markets determine that 10-year treasuries are going to go negative, for example, like they have in Germany and Japan, what should the Fed do? Should it leave its target interest rate at a much higher level than the 10-year treasury, or should it actually try to meet up with markets are saying and cut interest rates and go into negative territory? I say it's uncharted territory for the United States, and we don't really know what will happen if the world's reserve currency happens to be offering negative interest rates. Again, this could be deflationary. We certainly worry about that. And I'll leave you with the close here. Barring other mechanisms for weakening the dollar, the Fed could sop up foreign currencies along with the U.S. Treasury in the so-called warehousing operations. Interest rate cuts right now may be the only game in town that matters. Now everyone has to hold their breath and wait to see what the Fed does next week. What's it going to be, Fed? That's the commentary. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government. DailyTorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.